at trustandwill.com.
Welcome back to Squawk Box, everybody. This is CNBC, and we are just about a minute away from the March CPI inflation report. Ahead of that, let's check where the markets are, because we have seen some green arrows this morning. Dow futures are up, not as high as they had been earlier, but still indicated up by about 60 points. S&P futures up by 8.5, and then you've got the NASDAQ indicated up by about 30 points. Of course, we're watching Treasuries as well. Right now, it looks like Treasuries are a little bit, the yield's a little bit weaker. The 10-year is yielding 4.34. The 2-year is yielding 4.72. Let's call this at this point. Been watching very closely. This number is a big one. It's the inflation number, the consumer inflation number for the month of March. Expectations right now for the headline number, month over month, up 0.3%. That's the same expectation for core. Year over year, you're looking for a gain of 3.4% for headline numbers. Core, which strips out the food and energy prices, that is indicated or is seen being up by about 3.7%. But again, a lot riding on this because it will help determine whether or not the Fed can cut rates, and if so, how quickly. You're already seeing some pops in this even before the number comes out, and pops in the futures. Rick Santelli is standing by at the CME. Rick, take it away.
Yes, we are looking at yields popping up, and we are very close to the number here. They should be populating on the screen. This is, as Becky pointed out, March Consumer Price Index. The headline number expected to be up 0.3 is hotter than expected. It's up 0.4%, 0.4%, which equals our last look. And, of course, to look for a higher number would be August of last year when it was up 0.5. But in between, we're as low as 0.1 in October of last year. This doesn't seem like it's cooling very quickly here. 0.4 if you strip out food and energy. Back-to-back 0.4s last month as well. As Becky pointed out, we're expecting 0.3. To find a higher number, you'll go to April of last year when it was 0.5. And in between, the low number was 0.2 several times last year. If you look at year-over-year CPI, we're expecting 3.4, hotter than expected, 3.5. This is 0.3 hotter than we looked at in the rearview mirror, 3.2. To find a bigger number than 3.5, you're going back to May of last year when it was, I am wrong, September of last year when it was 3.7. And finally, what many would consider the most important number, year over year CPI core, 3.8. Hotter than expected, equals the rear view mirror. To find a higher number, January was 3.9. And what's the lowest it's been of late? Well, 3.8. Our last look and what we have today actually is the lowest since 3.0 in April of 21. The issue is it's still running hot. Now, many don't cover the indexes. To me, this is very enlightening. If you look at the non-seasonally adjusted headline CPI index, started in 1913. It's coming out today at 312.332, which is another all-time high, meaning if you go back to 1913, you won't find a higher number. And on the CPI core index, which is seasonally adjusted, the number here is 316.7, and that also is the highest ever, but this series was started in 1957. Interest rates, they're basically playing with 4.5% on a 10-year. We see pre-opening equities, Dow futures, have dropped to about 350 points. I am sure that the percentages are moving, and probably Steve Leisman will point that out. The June had popped back up above a 50% chance only slightly before the number, and I'm sure he will give us our updates. Becky, back to you.
All right, Rick, stay right there. We are going to jump into more on this data. We want to bring in Betsy Stevenson, the professor of public policy and economics at the University of Michigan, E.J. Antoni, who is research fellow with the Heritage Foundation, Joe Davis is Vanguard's chief global economist and head of the company's investment strategy group, and, of course, our very own senior economics reporter, Steve Leisman. Steve, jump right in on what Rick was just saying. What do you see?
Well, Rick teed me up. The market threw me a softball. I'm going to hit it. It's 28%, a massive drop in the probability for the June rate cut, falling down to just 28%. More importantly, even July now in play. We've talked about this now. July is under 50%. And if you give me 1 second, I can tee you up with where the market is looking, guys. If you can put up that January 2025 Fed funds contract. Mine is going to have to adjust here for a second, but we were looking for, now we're at 483, so we're just looking at 2 rate cuts this year, just about would be the odds-on bet. So we've gotten rid of 1, and I think we're toying with getting rid of 2 of them this year. First of all, told you I thought it was perhaps going to be a hot number. We got the inflation relief in places where it was predicted. The used car prices came down, new car prices came down, airline fares came down. All of that was as expected, which is kind of what makes this number a bit worrisome to me, because you didn't even have it in food. A bunch of it was energy, but also motor vehicle insurance, motor vehicle repairs. That was a big part of it. You were consistent when it came to owner's equivalent rent. That came down last month to 0.4. It was 0.4 again. So have to probe a little deeper, Becky, to see what the underlying inflation problem is here. But this is a number that is towards the high side, and it's going to put off rate cuts. That's the market's view, and I think it's correct.
All right, let's follow up with the market view again. Joe, I want to bring you in just to talk about what you're seeing. Is the market reaction justified when you have a number that's 0.1% higher? I mean, this basically, we were looking for confirmation that this was a seasonal issue, a one-off. 3 months in a row does not suggest that.
Well, no. In fact, I think our theme has been we would make progress on inflation this year, but it would be sticky. And we also believe the Federal Reserve is not nearly as restrictive as at least they think. And so I think, again, I've been confused of why the rush to cut. And I think the data coming in both on the labor market as well as today's inflation report say, just be careful of racing too soon to cut. There are still embers of inflation here and there in the economy.
We had, Betsy, I'll jump to you on this. We had an interview earlier today just talking about where you're going to see some of the gains, and commodities prices have been up across the board. Commodities analyst Jeff Curry said, look, that's a bad sign. That means that inflation is, he thinks this is typical of a late stage situation where you once again have commodities running. If that's the case, how can we possibly be convinced that inflation is going to come down over the rest of this year?
Well, I think, first of all, I just want to put it in perspective that we did the big fight. We got inflation down below 4%. I think everyone has known that this last bit is going to be the most challenging bit, getting inflation all the way down to the Fed's target of 2%. If you go back and listen hard to what Powell has said, he said, I'm going to hold rates longer than people expect. And, what we're seeing is the market now realizing, oh, they're going to have to hold rates longer than we were initially expecting. And I think that's because we did actually anticipate this kind of stickiness that we're seeing. I don't think there's anything in this report that I'm seeing that's telling me exactly why on this initial look, what's going on here that it's higher than expected. Everything seems to be going in the directions we expect, but maybe not as fast as we were expecting. And that's why we're just going to have to hold steady a little bit longer. And look, on the upside, the labor market is still strong. The economy is still strong. And so that's why the Fed's keeping their eye on the inflation prize.
EJ, let's talk about that. We may be facing higher for longer, but look, there are questions about whether inflation is a harder last mile problem or whether you think that there is inflation that is starting to bubble up again in other areas. Commodities leads to increases in food prices, increases in manufacturing, and that in turn could lead to higher, even core inflation down the road.
Certainly, and frankly, I'm not sure why anyone was really surprised by this number. 3.5 was exactly in line with my expectations, and it's not because I did anything special. I simply looked at the data coming out of commodities markets, coming out of the Treasury, coming out of the bond market, and it was very clear we were going to get a hot print today. It's amazing how the goalposts, by the way, keep moving. First inflation was transitory, then it was trending towards 2%. If you simply annualize the monthly data ever since June of 2022, it's very clear we were never trending towards 2%. We have been trending towards 3% plus. We've arrived there. There's no indication we're going any lower, because if you look at what's happening with the money supply relative to the size of the economy, it is growing much too fast. And as long as we have that pattern out of the federal government, we're going to continue to get these very hot inflation prints. And by the way, the first couple months of the year, these high readings were blamed on things like, oh, it's just seasonal adjustment, or it's one-off increases in this category, that category, whatever the case may be. We should point out core is running hotter than headline, and both trimmed mean and the median CPI are running hotter than core. In other words, these are broad price increases because it is the dollar that is losing value, not one specific commodity, item, or service that is increasing in price.
Let's bring up the futures board again, because I want to show folks what happened since we got this number very quickly. It looks like we are now indicated off by about 430 points. Futures were indicated up by 450 for the Dow futures before we got this number. You can see that with the S&P down by 67, NASDAQ indicated off by 250, and a big jump that we've seen in the Treasury yields, too. I want to get back to Rick, because I think the 10-year has seen a jump of more than 10 basis points since we got this number. Rick?
Yes, absolutely. Pre-number, we were at 434 in a 10-year. We're now hovering at what? Right under 4.5%. It really is a big jump. And if you look at the 2-year, it was at 472. It's now at 490. Not only are these yields high, but of course, we are well into new territory for fresh high yield closes, not only for 2024, which is very important, but going back probably now towards October of last year. And what's also interesting is the curve is not steepening on this number. It's actually getting more inverted by the tune of 3 basis points. What does that mean? That means the drop in the short end rate is more, a rise in the short term rate is more aggressive. So that means it's the Fed implications. It's what Steve Leisman talked about. What's under review in the marketplace is having a bigger push in short-term yields. The Fed does not like to see that. And as far as all our guests, all I can say is I don't understand, and I agree with, I think it was EJ, I don't understand how all these economists around the world, all these smart people can say we're making progress. We're not making progress on inflation. It's pretty much really comfy, at least based on CPI readings right here.
Betsy, you want to take that on? I mean, look, this is not 1 month of data. This is not one data point that you can write off as being a one-off. I mean, this is a number of points. And yes, you're right. We have seen a stronger jobs market under all of this. There are other issues that point to a stronger economy. But the inflation issue is persistent.
I think that most economists, if you've been listening, have been saying that bringing down inflation in goods was going to be easier than bringing down inflation in services, that service inflation was going to lag, because what drives service inflation is the fact it is labor costs, and people looking around and realizing, oh, prices have gone up. Now my wages can't buy as much as they used to. I need you to make me whole. I need you to give me a raise. And we're seeing that stickiness in services. And what we want to make sure is that that doesn't create a wage price spiral. I don't think we're at a wage price spiral, but at the same time, it's getting down all the way from, I really do think it's a last mile problem. And I know this is a really unpopular thing to say, but inflation in the 3s is not that bad. And I think we have to, take it at the right pace
on top of
and try to get back down
inflation we saw at this point. Betsy, it is. I'm sorry to interrupt. It's just inflation in its 3s is not that bad unless you stack it on top of the massive inflation that we saw for the couple of years leading into this. That's where you get it. It's not that prices not only don't come down, it's that they continue to build on 40-year highs in terms of inflation.
I completely understand that people are very unhappy about the level of prices, and that having had a history of higher inflation recently, after a many-decade history of people just not being used to inflation, has left people incredibly unhappy. But we also need to be careful in thinking about how hard we go at trying to bring inflation down. I think that the Fed is doing what they need to do. There are lots of people who've been screaming that they should cut for a while. They're holding. And I think that we need patience to get this last mile done.
The 10-year note now yielding
you're
above
just not paying
4.5%.
attention to the data.
Well, what,
The,
just
the
1 second.
annualized inflation rate last month was 15.5%. 15.5%.
Yeah, but EJ, here's the problem. The problem is that just because you're right now and inflation has stalled doesn't mean you were right before. We have made extraordinary progress in bringing down the inflation rate. That is incontrovertible if you look at the year-over-year rate and what it was. The bottom line right now, inflation has stalled. A Federal Reserve with a hard 2% target cannot cut into this environment. It is locked in by its rhetoric. It's locked in by its policy because inflation has indeed stalled at this level for whatever reason. It could be a matter of the money supply. There could be some one-offs. I'm not exactly sure, for example, what's happening, why motor vehicle insurance is going up by 2.6% on a monthly basis, which is a very high annualized rate.
That's just a rolling impact as those higher, as state by state, as insurance companies are allowed to raise their rates month by month, you're going to see that roll in as people's premiums turn over.
If that's the case, though, Becky, that's a one-off effect as it works through the system.
Effect that can play out over the course of a year.
Right, but it won't necessarily keep going. At some point, all of these states are going to come in ostensibly towards the beginning of the year. If that's a one-off, that's not my problem. My problem is you have the energy, the commodity prices are higher. There's the concern that those filter into core measures of inflation. The Fed hawks who are out there.
Into the wage price spiral, as Betsy was mentioning before.
I don't think we're there with that. I don't see wages pushing inflation at this point. But what you are seeing is you're seeing the effects of a hotter economy. The danger right now is this, and I'll stop here, is that the Fed has gotten away, the U.S. economy has gotten away with bringing down inflation with growth being relatively high and unemployment remaining low. That has been counter to the theories of how inflation can and often does come down. The danger right now is the Fed views this as, hey, we really have to slow this economy. We can't keep going with unemployment below 4% to get back to our target.
Sure. If you look at the dual mandate and figure, as Alan Greenspan always said, that you take care of the employment picture by making sure you take care of the inflation picture first, that would certainly necessitate that. And if you're talking about, okay, we don't have to get to 2% this year, this is not even on a track to get this down the road, which is why they wouldn't be able to cut into that. Rick, what are you thinking again as we continue to watch? The 10-year's now above 4.5%, and last I looked, the 2-year was knocking at 5%.
The most important thing hasn't been discussed yet. We have a 10-year note auction today, 30-year bond auction tomorrow. We've learned in the last 48 hours that our budget deficit's now all the way back up to $1.1 trillion. The cost to service our debt, I do believe that the last check we've written for basically a half a year was approaching a $500 billion to service our debt. That's all we need to say. Inflation has stalled. Interest rates go higher. The deficits are going higher. Government spending ignores all of this. I can tell you something, that most likely we're going to see 5% in a 10-year this year.
Yeah, I heard somebody just earlier this morning suggesting that maybe you see 5% before you see 3.5%. It didn't seem nearly as plausible as it seems at this moment with these huge jumps. Again, if you are following along on the radio, let us tell you about what's happened to the U.S. equities futures. Dow futures are down 400 points. That's a swing of 450 points from when we got this number 17 minutes ago. S&P futures off by 61. The NASDAQ indicated down by about 229. Joe, let's get back to you and just take a look from a trader's perspective, from an investor's perspective. Yeah. Is this something that is a knee-jerk reaction? Is this a complete overhaul of how you look at things? Because we're still talking about a pretty strong economy in a lot of other areas. Does inflation eclipse all of that?
Well, again, I think you have to certainly keep it in consideration. I mean, I think hearing all the perspectives just the past few minutes, I think what we will continue to see is a reorientation in the financial markets and, respectfully, of policymakers that rates are going to remain higher for longer. Now, again, this is from a firm, Vanguard, that we've done research for 2 years, arguing that rates were not going to test the global financial crisis era, that those days are behind us. And for a number of reasons, we're going to have a higher interest rate environment. That's good for fixed income investors. The equity market is fighting. I think it craves lower interest rates. I think we're seeing some of that reaction potentially today, the adverse reaction to that. But when you zoom out, rates are going to be higher, and the Federal Reserve is not as restrictive as they think. They are restrictive. But again, so I think what we will see is a reorientation, if this data continues, of cuts being continued to be priced out. That need not be the horrible thing for the economy. In fact, it would be a reflection of the fact that growth is holding up, but inflation, there's still room for improvement. Progress made, but room for improvement. I think that leads to where the bias we're seeing in the bond market today.
Okay. Joe, Rick, Steve, Betsy, EJ, want to thank you all for being with us on a pretty wild ride as we look through those hotter than anticipated numbers for CPI, both on a year over year and a month over month for headline and for core. We'll talk more about that in just a little bit.
Okay, meantime, when we come back, we're going to get you up to speed now that all of this has moved around on some of the top stocks that are moving in the pre-market, in large part as a function of this. We're going to ask former Federal Reserve Governor Rick Mishkin on how Jay Powell and the rest of the current slate of Fed members may end.
All right, let's see. Let's look through the markets. If I can get that shut off here. Let's look through the markets and see what we got going on this morning. Make it a little bit bigger. Wait till I show you the freaking 10-year. It's recovered some, but it was over 4.5. So SPY's down 1.25% pre-market. The Qs, the Nasdaq's down 1.35. Check out this 10-year. Ouch. That hurts. Let's see. See if we can go back and find. Hope it does not settle in above there. I don't know if you heard Rick Santelli there on CNBC saying that he thinks we're going to see 5% on the 10-year by the end of the year. So that would not be good. Let's check out FinTwit. See what we got going on there. We can see some perspective here. Make it a little bit bigger. Let's see. I saw some interesting takes I want to show. Right. All right, so let's see what everybody's got to say on Twitter. So I saved a few posts here I want to go back to and reference. So first thing I see is CPI for food and energy. February. There we go. That's what we're looking for. So I saw an interesting post this morning as I was scrolling through here. This guy was breaking down what he thinks is going to happen, as he was reviewing some data in CPI. So energy has been helping CPI, and March was the first month in the last 12 to see year-over-year monthly oil price increase, which this is only going to get worse, just with all the stuff going on overseas, not to get too political. You don't want to get me started on that. But here was today's. So he hit the nail on the head there, for sure. With that, so what else do we have? Expected energy now adding to the number, no change in rents or shelter. Massive 2.8% jump in auto insurance. Let me know in the comments below if you guys have had like an astronomical increase in insurance. I mean, it is unbelievable. I think the average homeowner's insurance policy went up. I want to say it was like 45% nationwide. It was unbelievable how much it went up over the last 12 months. Which, by the way, side note, just my mortgage lender piece coming out of me. If you have a mortgage and an escrow account, be checking your escrow account. And I would go back and get my insurance bill from last year and my insurance bill from this year to make sure they're similar. If they're not similar, you're going to have an escrow shortage here pretty soon, and your mortgage payment's going to go up if you don't go ahead and tackle that and get it taken care of. So just a side note there I would be looking for. Let's see. So here's the new CPI data. A breakdown of everything. See if anything stands out here. Seasonally adjusted. Up 0.4. Yep. Unchanged there. On shelter. New vehicles are coming down in price. Food actually went up again. Surprise, I'm sure everybody's seen that at the grocery store. Cereal. That's weird. Let's see. Alcohol's going up, cereal's coming down. It's good news for the health fanatics. Other food at home. Food away from home went up. Fuel oil. That won't be that low for long. Okay. Yeah, shelter was the same. I want to see the breakdown of this. Rent of primary residence went down. Owner's equivalent rent of residences. Additional services, transportation services. Wow, that is a very large jump. And motor vehicle maintenance and repair went way, way, way up. Look at airline fares. Look what's happened to airline fares. Finally got some relief there. Cool, let's see what else FinTwit's saying. I think I already saved that one. Let's see. That is the truth right there. It's just seasonal. It's just seasonal. Oh my fucking gosh. Yeah, that's pretty accurate. So a couple of takeaways from this is that, you know, at the end of the day, let's see what the 10-year is doing. 10-year's gotten a little relief. S&P hasn't really recovered much, and the NASDAQ hasn't recovered much. Actually gone down more. NASDAQ's down 1.5% pre-market. S&P down 1.25%. So not too far off. I think there's a couple things here, you know, from my perspective, is that number one, Fed's not cutting rates anytime soon. I mean, they can't. And the problem is they can't even give an indication that they are, just because the market's gotten so speculative. The speculation in the markets is out of control. So with that being said, they're not cutting rates anytime soon. I think from, you know, just being a mortgage lender, I think from a mortgage lender perspective, we are higher for longer. It's one of the big reasons that I used to shit on, you know, marry the house, date the rate people, because they married the rate and they just don't know it. and all these other mortgage lenders and real estate agents were out selling lower payments. And so even though they knew their payment was going to go up, they sold them the fact that, I mean, they were basically telling people that it was damn near guaranteed for interest rates to come down. And now these people are going to be living in this house for a year to 2 years or whatever. And with these temporary interest rate buy downs, where it goes to the final fixed rate after year 2 or after year 3, what's going to happen is, they're enduring all this inflation as well, number one. And number two is, they're more, at the end of the day, people that usually get sold on that stuff aren't great managers of money. Typically, they make emotional decisions. And with that emotional decision, what's going to happen is when these interest rates go up, we're talking full percentage points. So the way that it worked is the temporary interest rate buy down, if you did like a 2-1 buy down, let's say rates were 7%. Well, for the first year, your rate's 5%. For the second year, your rate's 6%. And then years 3 through 30, it goes to the 7%. So we're talking full percentage, a full percent in interest rate jump in the in their mortgage payments. So like, let's just say a normal house in the US, let's say, was it 400,000? So let's say a $400,000 mortgage. Let's see. For a $400,000 mortgage, let's say that rates were 7% when they did it. So that the payment would be $21.47 when they first started. After a year, it's going to go up to $23.98, so almost, a little over $200 a month. And then year 3, it's going to go to $26.61. So these people are going to get just the average, middle class American that's buying the average home, their mortgage payment's going to go up $500 to $600 per month in the first 2 years, right? So that's a major issue, and people don't plan for that. Even though you tell people to plan for it, they still don't plan for it, right? So I just think that from a mortgage perspective, rates are not coming down anytime soon. I think we're going to be in the 6 to 7% range for quite a long time until there is a major recession. Other than that, it just doesn't, like, there's no data and there's no indication that interest rates are coming down anytime soon. So let's see what else we got here. Bespoke. CPI was up 11.4% in the 24 months preceding the start of the Fed's tightening cycle. Now up 8%. Wow. So CPI has risen 8.6% in the 24 months since the start of the Fed's tightening cycle. And then CPI was up 11% in the 24 months preceding the start of the Fed's tightening. So they really haven't done much to inflation, is essentially what this says. If you can't read very well, that's basically what this says right here, is that, hey, we know, but we don't really give a shit. So let's see what else we got. Let's see. Okay. Shelter inflation, man, they're really gonna have to do something about that. That's right. 6-month light, yeah, that is very true. I don't buy the continued use of that argument. I would agree with that statement. He said warmer than expected inflation print. That's pretty good. I don't know. Did anybody see what happened? He's talking about yesterday here, but I don't know if you guys saw about 2 minutes before CPI was released at 7:28 this morning. The market, I mean, just down 1% in a matter of 30 seconds. Same thing here. Core goods deflation. See what else we got. Let's go over to Kevin. Kevin's one of my favorite YouTubers, and see what he's got to say.
a clear recession? Yeah. No, I'm basing this off of what Donald Trump himself has said. He's always said he's a late riser, previously in interviews, and he doesn't popularize that much, but he's previously mentioned that he'll wake up around, 10 or 11 sometimes because he'll work until like 2 a.m. That's just the way his clock is. And quite frankly, if you think about it, I mean, 10 a.m. is like 7 a.m. Pacific time. And I know that doesn't necessarily always align, but when we look at the market, I feel like it does. Market trading hours. Here, you want a pre-market trade, you got to be up at 5:30 in the morning. East Coast, you want a pre-market trade for an hour, you're going to be up at 8:30. It's not fair.
I have a lot of short rate paper, and I'm looking at it and I'm saying, wow, I mean, what do I do? Buy more short rate paper or buy CDs? The CD rates went down yesterday. It's kind of disconcerting. But I just think that there are a lot of people who are on the wrong side of this trade, and they're frantically getting out. And it's you see them first in the futures, and then there'll be a lot of people who are very scared, and they're in Mag 7, and they don't know what the Mag 7 are, other than the fact that it's...
Okay, I don't know what Kramer here is prognosticating, but you can see Sunrun, and we literally specifically called out Sunrun yesterday as being one of the more volatile stocks when it comes to inflation, down now 8.2%. So you could have picked up in hindsight here, obviously, a short. And even if you picked it up in the first minute or two, it has still been up on that short there on Sunrun. Look at that bounce there at the 174 on Tesla, trying to recover a little bit on the day. Got a gnarly bounce there. Now we're gonna watch the opening bell together, obviously, but we're also gonna do a summary here in a moment. I just want to get a few more comments here. I'm specifically looking for comments from Nick T. Let's see here. Okay. So Nick T did give us the trend chart. He indicated that, yeah, that's all he's actually given us. I'm actually surprised we're not getting a little bit more data from Nick T here, or charting at least. Usually he does a great job throwing together some more charts, but you do see that the trend of core prices on a 3, 6, and 12-month basis now all moving up. So we'll go ahead and put that over on ehack.com again. Full summary over at ehack.com, and check out the Stocks Insight group. We'll be raising the price in about 10 days as we come out with more lectures. If you've been adding lecture suggestions, by the way, I've been reading those. Thank you for those. Okay, so we have... That's Nick T. We've looked at his. Looking at some comments here. This is Reagan Capital says U.S. inflation is re-accelerating and interest rate cuts are off the table for the foreseeable future. Unpricing those rate cuts is going to be really interesting. Let's see. BLS blew it for Biden, says somebody here. June rate cut odds plummeted. Yep, we saw that. Morgan Stanley says, now we are raising concerns that the prediction of the June rate cut might not happen. No shit. 10-year auction, sloppy. To underestimate one or two inflation reports may be a misfortune, but to miss several in a row looks like carelessness. March's CPI takes the tally to the 4 consecutive year-on-year headline outturns greater than the median estimate. It's getting harder for the Fed to justify rate cuts at this point. Yeah, no kidding. Okay. Let's see. Morgan Stanley core CPI. We really need to get to 0.2 on a monthly basis to see rate cuts. Somebody else writes here, I wish the Federal Reserve would pay more attention to what they do to financial markets with their manipulation of interest rates. Right. That's basically a way of saying, like, hey, why are they suggesting they're still going to cut as the data's coming in hot? This has clear political and economic implications. Absolutely. Higher government spending is probably contributing to this. Let's see here. Monetary policy is not as restrictive as expected. I'm going to write this down. So we're going to write implications via Bloomberg. This suggests, so we're going to say policy clearly isn't as restrictive as the Fed would like or thought. There are a lot of reasons this could be. The Great Resignation during the pandemic may well have heightened productivity in the U.S. economy. Higher government spending would also push up the neutral rate of interest, but every time we get a hot indicator, the case builds that it has happened and the conventional measures of the neutral rates are too low. Okay, so raises, estimates, again, of neutral rate. Obviously, huge political win for Trump with first full cut priced after the election now. And then we've got, okay, we talked about 2-year. The morbid fear of central banks is to call an end to inflation only to see it revive. Yes. That's a good line.
All right, let's run over back to CNBC and see what they have. And then I do have like 1 or 2 other things that I saw on Twitter while we were sitting here waiting that I want to show you guys that are super interesting. Let's see here.
At a reason to bail, well, go ahead. I said it over and over again. After the GTC conference, the stock goes down. So now we're in the GTC conference. So what am I going to say? Wow, what a shocker!
Right.
Shocker.
As for the Mag 7 overall, mentioned it at the top. Alphabet, Amazon, of course, all-time highs.
Yeah.
Alphabet is something of a surprise. Again, I've made this point a number of times.
Turned out that YouTube,
given the existential crisis that lasted a week there for investors.
And Thomas Kurian is the star of the show.
Any
the
number
Cloud.
of well-known pundits reflecting on social media, for X, for example,
Right.
about the coming demise or questioning its ability to compete. And
Well,
lose,
it was
or
that
whether
was
it
a
would
real
lose its
surprise.
search
That got down to
By the way, it
that
might
was 16
still,
times earnings.
It might still have its monopoly
It had a
in
lower
search
multiple than
threatened.
ConAgra.
It might.
It had the multiple of a French fry company, for heaven's sake. Well,
Thomas
no,
Kurian,
Wesson
of course.
was bad.
Yeah, they had their big.
That's a big get, okay?
Yeah,
And
that
if
is a
you're
big
not
get.
respectful to Kurian and you call him Tom, interview over, partner.
Oh, really? I didn't know that.
Oh,
I'm
just
not-
the interview
not-
ends immediately.
Not familiar with the gentleman. You want to take a listen to what he had to say?
Why not? I mean, what the hell? What else are we going to do?
Yeah, I don't know what the hell else we're going to do. This
I mean,
was,
watch the market go down. Let's have some information.
This was him yesterday, the Google Cloud CEO. Take a listen.
One of them's offering a closed system. They have one model, one provider of that model. They don't even own that model. The other one does not have any AI expertise, so they only offer third-party models. We blend both. We have our own models, and we have the expertise to build systems and integrate these models into our products so that people can use it. At the same time, we're not taking a closed proprietary point of view.
I told you he's going to do 50 billion.
That full
Yesterday I told you he's going to do
interview
50
today at 1
billion. People are like, wow, what does that mean? Well, it means that he's doing very well. He's taking share, but there's a
Is
lot
he
of
taking
business.
share? There's an awful lot of share to
There's a
take,
lot of
isn't there? I
share.
mean, that's the point. You can have an environment in which the hyperscalers, Amazon, Microsoft through Azure, and Google Cloud all are beneficiaries,
We're in the
of course,
second inning of the whatever.
of what's happening in terms of generative AI.
Well, I mean, I hate baseball analysis because second inning, now baseball games go so fast. I don't want this to end. But I do think that the cloud is just in such demand. And they're only about 80, I'd say about maybe 15% of businesses have moved to the cloud. Mm-hmm. A lot of room.
It's a lot of room.
So let's read it. What do people do? Okay, so as long as interest rates are going higher, and we do have some auctions, and the auctions probably go badly, well, you start picking at things when you see things overdone, but you must know what they are, okay? You must know that AbbVie has a bunch of really good drugs, so when it gets to 4% yield, that's good, not bad. You have to kind of flip the equation and say, wow, you know what? This market's been good ever since the Fed pivoted, but now we're not sure about the Fed. Let's go back to what looks interesting. I mean, let's get granular because I really don't like this idea of the market. Let's talk about Caterpillar because we all know what Caterpillar does, right?
Okay.
Make Earth move. They do more than that, but they're central to. Not to China anymore, right? So CAT got up to 17.
All right.
And it's had a run of 25%, right? 25%.
I want to show you a couple things that I saw, and more importantly, a very interesting thought that I fully agree with. I'll get my screen right here. Let's see. Talks about inflation as a whole, but and why we can't overcome it, or why we haven't overcome it. Okay, so check this out. So, make sure I'm unmuted here. So with this, so I saw somebody retweet this and say, so basically it's Council of Economic Advisors, both headline and core prices as measured by CPI grew 0.4% in February and March, the same as the increases in the prior month, but both a tick above market expectations. And I saw somebody retweet this and say, they said, hey, Mrs. Johnson, this is Charles over at the bank. Hey, your account's just a tick overdrawn. And he said, see how dumb that sounds? It's just, it's another example of the government trying to make the bad data sound good, is what it is. And this is 32 minutes ago, but now the market is now only pricing in one rate cut, and it moved to November of this year. Okay, so this is the big piece I want to talk about here. So EJ Antoni, if you do not follow him, you absolutely have to. He is one of the best economists that I've ever come in contact with and that I follow on Twitter. He's the real deal. And everything's just very unfiltered. And as a matter of fact, he's a chart and data guy. That's it. No feelings. So he says, in other words, or I'll just let you listen to the video. That would be better, actually. I'll shut up.
CPI are running hotter than maybe. We should point out core is running hotter than headline, and both trimmed mean and the median CPI are running hotter than core. In other words, these are broad price increases because it is the dollar that is losing value, not one specific commodity, item, or service that is increasing in price. Maybe we should point out core is running hotter than headline, and both trimmed mean and the median CPI are running hotter than core. In other words, these are broad price increases because it is the dollar that is losing value, not one specific commodity, item, or service that is increasing in price. Maybe we should point out.
Okay, so I thought that was very thought-provoking, and that is something that I actually hadn't considered at all. Was the thought that that's why we can't, not to say that's why we can't tame inflation. There is a shit ton of reasons on why inflation is still here, and I think that is only one of those. However, it makes a lot of sense, from the perspective of government spending. They're devaluing our currency every single day, every single vote, and it gets worse and worse every single day. And until that gets under control, you're never going to see, inflation come back down. So we already kind of went through those. Less than 2 cuts priced in. I think we went through this earlier of the CPI in the 24 months precede. So before the Fed started tightening, CPI was up 11.4%. 2 years after the start of tightening, it's up 8.6%. The Fed's useless, is what that says. This was a little easier to read than the normal one, other than the one we looked at earlier. Motor vehicle maintenance and repair, hospital services, owner's equivalent rent. I don't know if you see hospital services 7.5%. I don't know if you've looked at the jobs data for the last 2 to 3 months, but it lines up pretty perfectly because there has been a astronomical increase in healthcare workers added to the markets, and that would mean that there's only one way to pay for them, and that's charge more. And so that's why you see the biggest rise in inflation on hospital services, owner's equivalent rent. This one actually really surprised me. Not to get too deep into the weeds, but at the end of the day, rent prices should be going down just simply because of the amount of inventory that we have, that's on market, and there's obviously a lot yet to come. I don't know most people have noticed the amount of apartment buildings and apartment complexes that are getting built in their home or in their cities. It is a crazy amount. So eventually there's going to be a ton of supply there, and those are going to have to come down. And rent does lag, by about 6 months, but they've also been this way for 2 years, so the lagging data is not really working too well. Electricity surprised me. Food away from home, all items were the 3.5. Alcoholic beverages, meat, but more pain at the grocery store and more pain at the pump. It seems pretty typical with this administration. Not to get too political, but I think we can all agree that this administration has done a pretty good job of causing this, and our congressmen, and the congressmen, Republicans spend just as much, if not more, than the Democrats. I'm Republican as the day is long, but they all just have a ridiculous spending problem. Used cars and trucks went down. Dairy and related products, new vehicles stayed the same. Natural gas, fuel and oil, airline fares. Look at that. That's crazy. So what else we got? This same thing we just saw, essentially. Transportation up 10%, shelter up 5%, overall CPI. Yeah, the same thing we just went through there. Go back, make sure I didn't miss anything. I agree. I saw somebody say earlier that, in economics, things take longer than anticipated to happen. And when they happen faster than expected. Let's see, U.S. factory activity. Yeah, the 10-year is almost at 4.5. So 125 basis point hit today. This is facts right here. I don't know if you can see this. This is funny. It says the Fed and inflation 2023, 2024 reps and right about them. I don't agree with this. They've been saying this rent lag thing for 2 years. I'm not even going to read this. These January seasonal anomaly. Yeah, they kept saying that January was just seasonal and that was it. Let's see. Huge shift in the bond market after the hot inflation report. And since he posted this, it's actually moved to November. Wow. Cool. Well, that's all I have. Make sure you hit that like and subscribe button. I try to do live streams on every big news day or every big report, and try to just share my unfiltered opinion from the perspective of a mortgage lender and a amateur economist. So, you guys have a kick-ass day. Make it a great hump day. Stay safe out there.